So, hi guys, welcome back. Today we'll be looking at Intuitive Surgical. This company has, for the first time over the last 20 years, has breached the $1,000 mark, and it hit $1,001 yesterday during the last trading session, and is currently trading at $999. So, Intuitive Surgical is an American corporation that develops, manufactures, and markets robotic products that help in surgery. And it has been growing amazingly over the last 5 years. We're looking at 332% percentage growth there as well. A market cap of more than $118 billion and a PE ratio of close to 75. So the stock is quite expensive, but it's been growing at a very good rate as well. So let's look at their investor overview. So their what they mainly sell is a surgical system called the Da Vinci surgical system. It's a robot-assisted surgery machine. It strives to make the surgery more effective, less invasive, and easier on surgeons, patients, and their families. So Intuitive Surgical is so far ahead of its competition. It has installed well over 6,300 of its Da Vinci systems that helps through multiple surgical procedures. Their accuracy leads to smaller visible scars and faster patient recovery times as well. The growth opportunity that is driving Intuitive Surgical's ability is to continuously expand the Da Vinci's addressable market to other surgical procedures such as the thoracic, gynecological, urological, and general surgical practice as well. So the more it develops the Da Vinci system, the more widely it can be used in many different surgeries, the more they can sell it for, and the more people that will be wanting to buy this. And as they develop that, obviously the company will grow, will make more money, and will therefore result in a better stock price there as well. So how has Intuitive Surgical been compared to most of its other medical peers and other of its close competitors? So Intuitive Surgical is in the medical sector, which is rank 16 in the Zacks sector rank. It also has a Zacks rank of 2, which is a buy. So the stock has gained 19.04% so far this year, while medical stocks as a whole has lost close to 2%, so it has been outperforming the whole medical sector. Between the medical sector, it has been specifically in the medical instruments industry, and out of the 95 companies there, the group has gained 7% as a whole, while Intuitive Surgical has grown close to 19% during this time, so has been outperforming competitors in its own sector and its industry there as well. So why should you buy Intuitive Surgical stock? What are the growth into the future, and why is this company a good company overall? So shares of this company have grown close to 64% with the industry growth of 21% in over the last year, while the S&P 500 is close to 38%. They have a market capitalization of $118 billion, and they designed the Da Vinci surgical system. It anticipates earnings to improve 9.4% over the next 5 years, and has beat its earnings estimates in each of its trailing 4 quarters, with the average surprise being close to 80% beating. So if we look at the price return performance since last year, we see Intuitive Surgical is more than 64% up and has been outgrowing the medical instruments market, which has grown 21%, and the S&P 500 of 38% there as well. So what are the benefits of Intuitive Surgical and their Da Vinci system? So on an overall basis, the recovery of procedures that happened gradually during the third quarter of 2020 attained approximately 90% of pre-COVID-19 levels by the end of the quarter. In the first quarter of 2021, they grew procedures by 16%, and they have placed 6,142 Da Vinci surgical systems in the first quarter, with the installed base growing 8% year over year. Mind you, these systems sell for close to $500,000 all the way up to $2.5 million per system. So 6,142 surgical systems that they have placed so far, on top of this recurring fees for them to touch it up. Improving the systems would also cost extra. So definitely this can become a recurring revenue stream there as well. On top of that, they have digital capabilities as well. They have My Intuitive, which is a mobile app enabling surgeons to manage their Da Vinci experience, log into their Da Vinci systems, and manage their training and view data in there as well, which has been helping during the public health crisis. So the telepresence program supported 45% of all case observations, up from less than 5% in the prior year. So the Intuitive telepresence program has been growing quite a bit over the last year. On top of this, it has lowered the costs of the team at Intuitive Surgical while boosting convenience for the customers as well. Overall, a win-win for both sides and both parties there as well. And surgical stimulation usage increased close to 46%, which shows how important digital tools have been to increasing the value of Intuitive Surgical's Da Vinci system. On top of this, it has also started gaining prominence in markets outside the United States. Mind you, the 6,300 Da Vinci machines that they have placed are majoritively in the US, but outside the US, the revenue hit close to 444.6 million, which is almost a 40% year-over-year basis growth. Outside of the United States, they have 108 systems in the first quarter compared to 55 in the prior year quarter. So they put in close to 53 new systems over the last year outside the United States. 59 were in Europe, 8 were in Japan, and 23 in China. So what does the future growth look for the stock as well? So Intuitive Surgical has had a very good upward trend over the last 5 years, as I showed you guys previously. So the consensus estimate for the second quarter of 2021 is $1.28 billion in terms of revenue, which is a 50.8% year from quarter 2 of 2020. And over the last 90 days, Zacks consensus estimate of its earnings have moved north by 10.3% to $13.58 there. So Intuitive Surgical, as I mentioned, creates the Da Vinci system. It is used for many types of surgeries. The company, as of quarter 2 of 2021 earnings, there were 6,335 of them installed, which is a 10% increase over the last year. If we look at this graph, their revenue has increased solidly, had a bit of a drop in 2020, but has been growing over time. Their foreign source of revenue has also been increasing, which is their biggest growth story in the future, which is markets outside the United States. And their foreign source revenue as a percentage of the whole has also been increasing, which shows slightly slower growth in the United States, but a really big pickup in growth outside the United States as well. If we look at here, their revenue has been increasing quite a bit once again. A very important part, their reoccurring revenue has also been increasing, which as reoccurring revenue increases, that is more positive for the company. The more they can base their future spending, their future risk taking, and also provides a sense of security for the shareholders as well. So as recurring revenue as a percentage also increases, the more positive it is for the company. So once again, we've seen recurring revenue increase. So once again, that is very good for the company there. So 2020 saw a small dip due to the COVID-19. However, they still had a positive earnings before interest, tax, etc. above 35% and net margins over 30% as well. The company is performing very well, and it has been for years. If we look at Intuitive Surgical compared to many of the other companies, some of the most successful companies around the world, we're looking at Apple, Amazon, Tesla, and Nvidia. We can see the net margin for Intuitive Surgical, which is the blue one, has regularly been the second or the third highest, usually behind Visa and Nvidia or just behind Nvidia, which shows a very good use of revenue, and they don't have to spend too much of their revenue onto developing or spending too much they have more money able to kept within the company, and therefore more money distributed to shareholders and more money at the end to actually reinvest into the company. So their expenses are not too high, which is a very good sign. Compare that to Amazon, which is an amazing company, but it has a net margin that is quite low because the business that it runs is very research and development heavy, and is also quite capital intensive there as well, especially because they have to pay on especially in their e-commerce, but then they also have AWS services on the side. So if you look at earnings before interest tax, once again, Intuitive Surgical ranks one of the highest compared to some of the best companies around the world. So once again, a very good sign. They have a very high earnings before interest tax margins here as well. So if the next thing we'll be looking at is their Q2 earnings highlights. So worldwide, Da Vinci procedures grew close to 68% compared to Q2 of 2020. The compound annual growth rate between the second quarter of 2019 and the second quarter of 2021 was 16.5% there. So as Da Vinci procedures become more and more useful, more and more hospitals will be looking to purchase a Da Vinci surgical robot, and of course that benefits Intuitive Surgical in this regard as well. The company shipped in Q2 of 2021 328 Da Vinci surgical systems, which is an increase of 84% compared to the 178 that they shipped out in second quarter of 2020. They grew its installed base to 6,335 system as of June 30th, which is an increase of 10% compared to 5,764 systems in second quarter of 2020. Their revenue of 1.46 billion was a 72% increase compared to the 0.85 billion in 2020. Their GAAP net income was 517 million or $425 per diluted share, compared it to 68 million or 0.57 cents 57 cents per diluted share. So once again, a very, very big growth there. And then non-GAAP net income was 477 million or $3.92 compared to 132 million or $1.11. Both were looking at massive growth in net income specifically, which is a very good sign for this company. So next, if we look at their earnings per share, the earnings per share has been growing consistently over the last 10 years, a very good sign. They don't really pay out dividend. However, their book value per share has been increasing as they acquire more and more assets. It's nowhere close to their actual stock price, but it is a good sign that their book value per share is increasing. Their operating cash flow is increasing, their cap spending has kind of plateaued, and their free cash flow is increasing. So the company's not spending too much on research and development nowadays, but it's spending enough to increase its revenue and profit. Its net margin is more than 30%, which is amazing use, especially for a company that invests a lot into research and development. The return on equity is slightly lower, but a return on equity of 17% shows pretty solid use of shareholder equity there as well. They don't have any debt to equity, which is a very good sign. And if we look here, their interest coverage is also 0, which is amazing, especially for a company that is growing. To have very minimal debt is almost it's really, really good for the company to take risks in the future and to invest heavily without actually hurting its cash flow and balance sheet. If we look at the PE ratio, as I mentioned at the very beginning of this video, it is quite expensive. We're looking at a PE ratio of close to 75, much cheaper than what it was in 2020, where it hit 93, but the current PE ratio is still very, very high. Their price to forward earnings is set to not decrease that much, about 0.6. So the company's stock price isn't probably going to change too much as compared to its earnings over the next year, but assuming we're looking at a 10% increase in earnings over the next few years, we should be looking at close to a 10 to 15% increase in stock price as well. Especially have a stock price that's about $1,000, we're looking at $100, $150 if you just own one stock, which is very, very, very solid growth over the next year. It's not anything flashy like 40-50% growth, but a solid 15% growth year over year is very solid for a company at this size. Their PEG ratio is currently 5.53, which is once again quite high. So the company isn't going to be growing as fast as it is valued. I expressed my sentiment towards this earlier as well. And because of this, I would not individually buy this stock. I believe it's slightly too expensive, but it does show very promising future growth there as well. So if we look to this last one over here, we can see the stock price. The stock price has grown tremendously over the last few years. From 2017, we were looking at close to $250. Currently, we're looking at close to $1,000. The stock price has recently rebounded at the very beginning of 2020. This is where I would have entered the market. You're looking at closer to the 50-day simple moving average, and since then the stock has risen from just about 700 to 1,000. So we're looking at a very solid growth over the last few months, but currently it is far too expensive for my liking. You're looking at close to $100 over the 20-day simple moving average. You're looking close to $200 over the 50-day simple moving average, and more than $400 over the 200-day simple moving average. So overall, although the company is very, very solid, it controls a huge portion of the market. It is far too expensive for my liking. But if you do choose to invest, make sure to do your own due diligence. Also, if you made it to the end of this video, please do consider subscribing. It does help me out a lot, and I'll see you in the next one. Bye.